Hello, it's Jonathan Wellham of RockLinc Investment Partners, and it's November the 4th, 2014. Well, I want to talk to you today about the issue of volatility. And if you've been following the markets over the last 4, 5, 6 weeks, I'm sure you've noticed a lot of change in prices in the marketplace. So when we're talking about volatility, we can look at it on a number of levels. If we think about volatility in terms of equities, we saw at the beginning of October sharp sell-off in the equity markets, the S&P 500, the stock market in the United States, in Canada, the TSX. In fact, many of the markets dropped in the first couple of weeks of October over 10%. And then in the latter part of October, they quickly rebounded again. And so it really threw people to see such extreme volatility. When you look around the world, it probably surprises some people, but most markets around the world year to date are actually negative or have done nothing. It's really only the Canadian and US markets that are up a little bit this year. In terms of the currency markets, wow, I mean, there's just been amazing moves in terms of currency. In particular, the US dollar really has been on a one-way move up, and it's gone up around 10% against sort of the global basket of currencies. But when you start looking at individual currencies vis-a-vis the US dollar, our own Canadian dollar is down about 10%. And that's not a big issue for us, particularly when we're buying equities, because most of our equities sell into the United States and around the world, and also most of them are involved in hard asset businesses which are denominated in US dollars. So often when our dollar drops, our businesses often will go up in value to offset that, sort of a hedge. But nevertheless, our Canadian dollar is down about 10% year to date. The Australian dollar down about 12%. The euro is down about 10% so far this year, but most of that in the last 6 weeks as a result of tremendous softness in Europe. And when you look at the yen, it's down over 30% year to date. And in fact, it's down about 44% from its high back in 2011, as that country just reels from a tremendous debt crisis and ongoing money printing, which we'll return to in a moment. When you look at the bond yields or interest rates on bonds, it's unbelievable. They continue to plummet, and plummet is the operative word. If you look at the 10-year yields on various government debt, we'll start with the United States. We can see that the 10-year yield on government treasuries in the US is now only 2.31%, which is pretty close to a record low. Now, briefly in October, early October, they did drop just below 2% in a very panicked market, but then bounced back up to 2.3. In Germany, the 10-year yield is only 83 basis points, so 0.83% on a 10-year note. In Spain, which is a very weak economy, but nevertheless, their 10-year yields are 2.12, so actually lower than the United States, despite a very weak economy and a very troubled monetary situation in that country. In Japan, which has the largest debt load of anybody in the world, I mean, you can hardly make this up, their 10-year yields are 43.5 basis points, so 0.43%, less than 0.5% per year. So this is amazing. Here in Canada, just by way of contrast, our 10-year notes are about 2.03%, so very, very competitive and actually less than the United States. When you look at commodity prices, we've seen big moves in commodity prices also, particularly in oil. Oil recently has dropped about 25% from over $100 a barrel to well under $80 a barrel as I'm doing this video. And so you've seen tremendous volatility there. Now, the oil companies and companies we have exposure to in the oil and gas sector are really very cost effective. They're low cost producers. They're vertically integrated in terms of refining, retail distribution, and so on. So we're not overly worried about that, but there's a lot of energy companies that are just being eviscerated with this recent drop in the marketplace. And also the gold and silver has been down in US dollars about 4 or 5% this year, but if you compare it against other currencies, actually gold has been up. If you were to look at it in yen or even in Canadian dollar terms, we'd be up still this year. But nevertheless weak when you'd think, and we do believe over time, gold and silver should be much, much higher. So that's what's been going on, a volatility, lots of moves. This shouldn't surprise us. The Federal Reserve has just recently ended its QE, or its money printing exercise. And so over the last 5 years, the U.S. Central Bank has added over $4 trillion to the money supply. And the bottom line is it has done nothing to improve the productivity of the country and to increase the income levels of the average American. And that should not surprise us. Money printing does not create wealth. It might lift asset prices, but it just punishes those who are not asset owners. And so you've got this really bifurcation of the market. People who do own assets and have the productive resources, can hedge themselves, but people who don't just get hammered by money printing. And so even Alan Greenspan, who used to be the former head of the Federal Reserve, has admitted that demand is dead in the water, in his words, and if people were smart, they wouldn't be putting their faith in the central banks. And remember, he used to run the central bank, and he advised that people should back up the bus and buy some gold, which we find quite intriguing that someone could flip in their position so dramatically simply as a result of a positional change. So at any rate, it's a very interesting market. Now, right after the Federal Reserve stopped their money printing exercise for the time being, Japan went all in and expanded their money printing, or their QE. And at this point, Japan is monetizing all of their deficits. So any of the deficits that the government is running, the Japanese central bank is buying it all with newly minted yen. And so just out of nothing, creating dollars. Europe also is challenged to print money, but the Germans at this point have been holding back and containing the ECB in terms of how much it expands the money supply. So it has been relatively small there when you compare it to the US or to Japan or to the UK. So what's going on? Well, what's going on is really this whole pressure towards deflation. There's so much debt in the system, and that debt is so unproductive, and the addition of new debt is largely unproductive debt. When I say unproductive debt, it's not creating or going into assets that create an income stream to fund the debt. It's wasteful spending, and wasteful spending is going to kill us and kill our economies. It's certainly not going to give us growth, and that's why you don't see economic growth in Europe. That's why you see negative growth in Japan. That's why you're seeing slowing growth in China. And that's why even in North America, our growth is mediocre. It's pathetic at best, and certainly not even keeping up with the expansion of our population. And so when you think about what we're in for right now, I think, look, we're in for a tough environment. That's why we want to be in great companies, in great businesses, keep powder dry, take advantage of volatility that will inevitably occur. There was a recent report that was just put out talking about the debt to GDP level, so the total value of debt, and you compare that to the total production of the economy. And in the United States, that debt to GDP is currently 334%. At the peak, it reached 360%. So it's very little change from the peak debt conditions just a few years ago. But when you go to Europe, you see that the debt to GDP is actually 460%. So 4.6 times the production within the economy in a year. And in Japan, the debt to GDP is 655%. It is not recoverable. It's going to have to be restructured. So when we look at that, we go back to our investment approach and we say, look, we're not looking at geopolitical events. We can't predict those. But when we look at the credit markets and we look at the financial conditions of our major countries, it means that there will not be rapid growth. And it means that we must be prepared for slow to weak economic growth and a lot of pressure. And therefore, we want to be in the best companies with pristine balance sheets and really solid industries, and hedge ourselves as best as possible with some cash and also some investments in some of the gold and silver areas, which have been pummeled and are really cheap and are going to provide some of the largest opportunities going forward. But we only go into that space in a very careful manner and keep a certain weighting in that area. So we've made pretty good progress this year despite all of that volatility. But more importantly, we like our positioning going forward and remain committed to being conservative, careful, diligent, and very prudent in a rough environment. So thank you very much for listening, and I trust that's helpful. Goodbye now.